Welcome to this episode of SF Conversation. I'm Hélène Heberlein, and I'm joined today by Cosme de Montpellier from the cover bond analytical team at Fitch. We're going to have a brief conversation about the trends we see in our market and about our recent revision to the cover bond rating criteria. Thanks for joining us today, Cosme. As a first question, we've been receiving recurring inquiries about the way we take into account country risk in our cover bond ratings. It's a legitimate question. Most of our ratings are AAA, and we rate cover bond programs often above the sovereign debt of the respective country. So can you explain how cover bond ratings are impacted by sovereign rating?
Yes. So we rate cover bonds out of 18 countries, but only 5 of them are rated AAA, while 80% of our cover bonds rating are AAA. So it's quite often the case that we rate cover bonds above the sovereign. But it doesn't mean that cover bonds rating are not influenced by the sovereign rating. It can be influenced in 4 different ways. First, via the country cap, which is a maximum 6 notches above the sovereign rating. So it means that if a sovereign is downgraded below single A-, then a AAA rating on the cover bonds is not achievable anymore. Second, via the issuer rating, either directly or indirectly. Directly because typically an issuer in a country is not rated above the rating of the sovereign unless it has a very diversified business model, and indirectly via the operating environment score of the viability rating of banks. Third, a sovereign rating can influence cover bonds rating via the over-collateralization supporting the rating. For instance, we calibrate our AAA stresses to the country cap, or also the sovereign spreads can influence cover bond spreads, which can influence our refinancing spread levels and the level of over-collateralization supporting the rating. So this could impact the cover bond rating if the over-collateralization available in a program is not sufficient to sustain these stresses. And a fourth way, maybe more obvious way, where cover bond rating are influenced by sovereign ratings is for public sector for cover bonds with exposure to the country. So for these programs, the over-collateralization is unlikely to support stresses much above the sovereign rating. So they are the first to be impacted when there is a sovereign rating action. Overall, the credit quality of cover bonds is very strong. I'll just give you a few metrics, but out of the 18 countries where we rate cover bonds, we have only 2 on outlook negative, 3 on positive outlook, and all the others are on stable outlook. We have 7 cover bonds rating on outlook positive, only 1 on outlook negative, the one in Poland. And we have all cover bonds but 2, which are rated AA or higher, with none of our cover bonds rating being constrained by OC. So overall, a very strong metric for cover bond.
Very well, thank you, Cosme. We've just published a revision to our cover bond rating criteria. Could you summarize the changes and how they potentially affect ratings?
Yes, so we have made small revisions to our cover bonds rating criteria with no rating impact, but we've mainly changed 2 points, one relating to the resolution uplift and the other one to the calculation of the break-even over collateralization for the rating. So first, on the resolution uplift, so we now have more clarity on the resolution path for banks and the likely impact on cover bond ratings. So what we'll do is we will differentiate between banks which have raised resolution debt buffers and banks which do not have debt buffers. So for banks which have resolution debt buffers, we will apply the maximum 2 notches of resolution uplift. For banks without debt buffer, the resolution uplift will depend on many different factors. First, the quality of the cover pool, whether they are made of standard assets. Second, the size of the cover bond market. Third, the type of cover bonds, whether they issued under a dedicated legislation or not. And obviously the likely path of resolution for banks in that particular country. So the resolution uplift for these ones will be up to 2 notches, but it could be 0 notches. This change has very little impact in practice. It only impacts 5 programs for which the resolution uplift would move from 1 notch to 2 notches, but it has no rating impact. And the second major change to our rating criteria regards the calculation of the break-even over collateralization for the rating. So we used to calculate it based on the stresses in line with the cover bond ratings. So for AAA cover bond ratings, we would use AAA stresses. But we now recognize that the issuer can absorb part of these stresses before it fails. So in practice, what this means is that we will apply a 25% haircut to the model output when calculating the break-even OC for the rating, and only for issuers with a resolution reference point, so the issuer rating plus the resolution uplift of BBB plus or above, and for issuers which have available unencumbered assets. So this change has an impact on most of our cover bond programs. So they will have a reduced break-even over collateralization for their ratings, but it has no rating impact because none of our cover bonds are constrained by over-collateralization.
Perfect. So different reasoning for the resolution uplift and the 25% reduction in break-even over collateralization for most ratings. Moving on to our last topic, the European Banking Authority has been preparing a recommendation for the recognition, regulatory-wise, of third country cover bonds for EU investing banks. And in the UK also, we have a consultation going on at the moment. And obviously, there is cross-border investment of EU banks in non-EU cover bonds and of UK banks in non-UK cover bonds, which are set up in a very similar way. So what are the conditions for a full regulatory recognition?
Yes, so we are getting closer to an equivalence regime, but it's a very long journey. So the EBA has already made clear that they are supporting an equivalence regime for third country cover bonds in the EU. That would see non-EU cover bonds benefit from a favorable treatment in terms of risk weights and LCR eligibility for EU investing banks. But there would be a number of conditions to be met. First of all, technical standards would need to be met by the third country cover bond legislation. But also there are two major conditions for equivalence to be granted. The first one is reciprocity, and the second one is the maturity of the cover bond market. So first on reciprocity, so third country cover bonds will get an equivalent recognition in the EU only if EU cover bonds get a favorable treatment within the third country cover markets. So that will mean it will take more time for equivalence to be recognized because both sides need to agree on the equivalence. And the second, the equivalence would only be given to cover bond markets which are sufficiently mature. That's what the EBA is recommending. And that means that it's more likely that equivalence will only be granted to the larger third country cover bond markets, which would be the UK, Switzerland, Australia, and Canada. For our ratings, we rate the vast majority of third country non-EU cover bonds AAA. So it's 48 out of 49 programs are rated AAA. And we think it's reasonable to apply lower risk weights to these cover bonds, which are highly rated and are issued in countries with low country risk. However, we think in terms of the LCR eligibility and the measure of liquidity, it's less straightforward because our ratings do not embed a recognition of liquidity.
Thank you very much, Cosme, for joining us today. And thank you for watching. If you have any questions or would like to continue the conversation, please send us a note at the address on screen.